Hi, I'm Mark King, Head of Content at Columbia Threadneedle Investments, and welcome to another episode of Credit Threads, a special fixed income focused podcast from the Eye of the Needle team. Credit Threads takes a regular look at macroeconomics, central banks and inflation, and their impacts on credit markets. And joining me for this episode are Al-Hussainy, Senior Rates and Currency Analyst at the firm, and Adrian Hilton, Head of Global Rates and Currency. I'm also joined by my co-host Chris Morton, Fixed Income Client Portfolio Manager. So Chris, it seems to me there's a lot of catalysts for bond markets in the coming months, including the US Federal Reserve and its intention to taper its asset purchases, the Fed again and its plan to raise interest rates, and of course, ongoing inflation data.
Yes. Hi, Mark. In fact, we were just talking about all of this in our Global Fixed Income Roundtable yesterday, and we were thinking about it specifically as it relates to navigating potential volatility as the Fed tries to unwind its very accommodative stance it's been in since the global pandemic hit last March. There's been a lot of what we would call noise, which has created significant volatility in interest rates. And what we're trying to get to the bottom of is the actual signal. So how does growth really look from here? How is the labor market shaping up? Is the Fed's expectation for inflation too low, too high, spot on, and trying to really figure out that kind of noise to signal ratio. So Ed, I'd like to start with you, and let's start with inflation. At this point in the game, is the transitory versus persistent story for inflation even useful?
Yeah, I think there's sort of two elements here. One is the language, and when the Fed is talking about transitory inflation, they're really talking about the nature of the inflation formation process. So how do households, how do individuals, how do corporates come together and form inflation and inflation expectations? The core bet that the Fed is making is that that process remains intact and broadly unchanged. And that's shaped by structural factors, demographics, technology, globalization, and so on that have been with us for decades. The elements of inflation around which we can have confidence are really around the goods side of the economy, and that's durable goods. Consumption is disproportionately shifted towards goods in the course of the past 18 months. We're fairly confident that that balance between goods and services will normalize. That process has begun, but it's taken a lot longer given the supply chain disruptions that we have seen and the fact that the economy still isn't fully open after the COVID shock. So that process will play out, and some of those prices will start to normalize next year. But the Fed is betting that inflation, as a result of that normalization process, returns to 2%, roughly 2%, which is their target. The question that we will try to answer next year is, once some of these elements are out of the system, has the underlying process changed? The economy is in significant flux. We've all gone through a significant shock. Whether the underlying inflation process has changed or not, it's still too early to tell.
As you say, what the Fed is betting on. Sometimes I picture Chair Powell and his FOMC at the ports in California, just kind of trying to bring those ships in. When you think about inflation, what data, I'm often asked this question, what data are you actually looking at? What does your crystal ball or tea leaves tell you? And then what could we advise others to look at as possible indicators of transitory versus persistent?
So I would focus our minds on two elements. First, the front end of the curve, where we're pricing how quickly the Fed will lift off and how quickly the hiking cycle will start. At the moment, Fed is trying to separate the taper discussion, and the taper is very likely to be on track to kick off in November or December, go through the middle of next year. That discussion from the discussion around when federal funds will lift off from zero. So that liftoff process has a much higher threshold. The thresholds for liftoff are maximum employment, their inflation running marginally above 2%, their inflation expectations getting anchored around 2%. And that's a relatively difficult complex of targets that the Fed is trying to achieve. So in separating those two, the Fed is essentially trying to tell the markets that you should delay pricing a hiking cycle. On the other hand, as inflation has come in definitely above the Fed's expectations on a year-on-year basis, inflation's running at close to 5%, or marginally above 5% at the moment. The market is essentially watered down the Fed's guidance and priced in a pretty aggressive hiking cycle. So we have at the moment, markets are pricing that liftoff for the fourth quarter of next year. That's very quick, and that's put some pressure on yields in sort of the 2 to 5 year segment of the curve. The long end of the curve, in addition to pricing what the Fed will do over the next 10 years, includes something called the term premium. And when you think about term premium, a big chunk of that term premium is uncertainty about what inflation will look like. As we price a more aggressive hiking cycle, we reduce the odds that inflation is going to be high in the future. We bring that term premium, we bring that uncertainty down. And as a result, those long end yields have really struggled to make headway higher. So think about 30-year yields right around 2%. We've not meaningfully moved above that really since the spring. And so I think the tension going into next year is, how do we price the Fed? Does the Fed push back on market pricing? And how much of that inflation premium remains in the longer end of the curve?
Adrian, in the UK, we've seen a spike in inflation driven by energy prices. Do you think the US is blazing a path that the Eurozone will follow? And then would the ECB follow the Fed into a tightening cycle?
Yeah, I mean, as is often the case, central banks everywhere, whether it's the Fed, the ECB, or the Bank of England, they're all kind of confronting the same problems, just with slight differences in nuance. The policy dilemma is somewhat the same, and it's kind of based really, I think, on trying to determine what kind of inflation central banks need to respond to. I think as we came out of the pandemic in the first half of this year, as we came out of the pandemic restrictions, I suppose I should say, in the first half of this year, a lot of that demand pressure was being felt through goods, as Ed alluded to earlier on. And that's very much a sort of demand pull impact on prices. What we're seeing now is more kind of supply side driven pressure on prices, which is a much trickier thing for central banks to respond to, because of course that exogenous shock to prices carries with it risks to real disposable incomes and therefore to growth. So, in answer to your question, is the ECB about to follow the Fed? Well, it's starting to be priced in some way, and there's definitely one of the measures we look at is expectations in the market of say 1 year European euro rates 2 or 3 years down the line, and we're starting to see some uptick in expectations there. And interestingly, the ECB is not pushing back on that pricing quite as vigorously as we might have expected. Same in the UK, but in the UK, I think the central bank is being even more explicit about its desire to get rates away from the lower bound. And even over the course of the last month, we've had a massive increase in the amount of policy tightening that is priced into the very near-dated Bank of England meeting. So even by the December meeting now, there is a full 25 basis point rate hike in the price, and that to us seems pretty bold, when you kind of consider that we still don't really know which kind of inflation we're shooting at now. And as we come into a period next year where we think the fiscal screw is going to tighten somewhat, we've just had the end of the furlough scheme in the UK, so we're going to find out just what state the labour market is in now, and that's true to varying degrees across Europe as well. So we're in a period where I think there's an awful lot of uncertainty around the future for economic activity, yet we are starting to see a degree of policy tightening being priced into markets.
Interesting. And how are you thinking about inflation as it relates to emerging market and valuations there?
Sure. Emerging markets have kind of additional problem in the way that their central banks can respond to inflation, and it's born out of the way in which their central banks don't have the same credibility when it comes to being able to maintain inflation within target ranges. We've had now 20 odd years or more in developed markets of inflation targeting central banks. They've generally had a very good track record of keeping inflation within target bands. In emerging markets, clearly that credibility is not quite as dependable. And so there is an additional pressure on central banks in emerging markets to defend pressure on currencies when it arrives. And of course, that is another channel through which underlying inflation pressures can be exacerbated via depreciation of their currencies. And there is more of a need to tighten into near-term inflation in order to try and get on top of expectations further down the line, even if the underlying economic fundamentals don't really justify it. And in a lot of emerging markets now, we've still got negative output gaps. That means that growth is still running at some way below its potential, yet central banks are feeling compelled to raise interest rates.
Adrian just mentioned the labour markets, so let's talk about employment targets. How's the Fed going to square its goal of achieving full employment alongside broader inflation numbers that may be higher for longer? Have they put themselves in a tough spot here?
Yeah, I can take that. So don't know yet if the maximum employment mandate and the new inflation strategy are in conflict for the Fed. They've not been in conflict so far, and the Fed is, triggered the thresholds to be able to start tapering. I think the question is really going to be pertinent next year when we start to think about whether we've triggered the threshold for the hiking cycle. And the Fed has set very high bars for both, right? So maximum employment is a very expansive definition that moves us away from the full employment view that the Fed has worked with over the past 30 years. The inflation target is not just inflation hitting 2%. It's inflation averaging 2% over some look-back period, which the Fed has not specified yet. It's inflation likely to remain there in the future. And it's the Fed's reading of inflation expectations, keeping inflation there in the future. So it's a set of very difficult tests that the Fed has set for itself. Are they likely to be in conflict with each other? I think it's very possible. If inflation turns out to be more persistent, if some of the supply side issues we've talked about turn out to be persistent, and I think this is the pain point for the Fed, if the underlying inflation process has changed, and we really won't know likely until the end of next year, possibly even beyond that, whether that's happened. If that's the case, it puts a lot of pressure on the Fed to adjust to that process, adjust monetary policy settings to that process. Whether they'll have to sacrifice maximum employment or redefine what maximum employment means, I think is an open question.
Ed, you mentioned the inflation process just now. What exactly do you mean by that? What is that process?
Yeah, I mean, this is what makes, I think, prognosticating about inflation interesting, is we have a very poor understanding of how inflation is formed. We have perhaps a marginally better understanding of how prices are set in certain sectors and certain industries. But in aggregate, why is it that inflation fell so dramatically in the 80s? Why has it remained there? Why has it chronically undershot the Fed's 2% target over the past 20 years? And when we look around the globe, why is it that inflation seems to be anchored around 1% in Europe and 0% in Japan? Those are very difficult questions. They, of course, have to do with demographics, with aging. They have to do with the shift of what we consume away from goods towards services, which are deflationary. They have to do with technology, which of course is flattening out pricing. They have to do with competition in markets, which are becoming much more concentrated and therefore less competitive, and so on. And all these structural factors, how they come together and how that mix changes over time, we have a really hard time disentangling that process. As a shorthand, I kind of think about inflation being influenced by psychology and power, right? So psychology is our expectations as individuals, as households, as corporates, and those things become embedded, particularly in wages, right? And how wages are formed. And then power has to do with bargaining power on the labor market side, and the pricing power on the corporate side. And these two things very likely have changed in the course of the pandemic. Now, does that mean inflation settles at a higher run rate, or does it settle at a lower run rate relative to 2% or relative to where we were in 2019? That's an open question. But this is what makes it exceptionally difficult for the Fed and for us. I'll add one footnote to that. Fed has much more explicitly recognized the limits of their ability to forecast inflation. And I think that's sort of a turn across major developed markets, central banks, is much less emphasis on their forecasts of inflation, which used to carry a lot of weight before. Now they carry a lot less weight. So that's changed the way central banks behave just in the course of the past several years.
Let's talk a little bit more about the taper. I don't think it's going to surprise anybody if the taper begins in November, December timeframe. That seems to be the consensus view. Does that mean that it's priced in, or should we still be expecting a little bit more volatility, not just in the asset classes that the Fed's been buying and going to start tapering on, agency mortgages and treasuries, but should we expect there to be some spread widening, risk off mentality around credit products as well?
So even as the taper plays through, the size of the Fed's balance sheet is still growing. It's just growing at a slower pace, and at some point next year, it flatlines. The fact that the Fed is carrying a stock of assets that large should still be supportive of risk. So, and that was kind of our learning from the 2017-2019 period when the Fed actually tried to reduce the size of its balance sheet. It did so at such a slow pace that the stock effect really dominated, and risk assets didn't really react to that in any negative way. The key thing, I think, tends to be guidance and surprises. The Fed has done a really good job of telegraphing this. They learned from the 2013 taper tantrum period when that communication was not very clear and was a shock to markets. They decided, I think correctly, that they didn't want to be anywhere near a situation like that again. And they communicated very clearly around what the taper is going to look like. So no surprises around the taper. I think most of the surprises will be around when they lift off.
Yeah, and actually, I think that's one of the big banana skins here, right? Is that, and this is what the Fed, I think, and other central banks, although they haven't always been aiming at exactly the same outcome, what the Fed's been very careful to do is to try to make a distinction between tapering and the first rate hike, and because it's when markets conflate those two things that you can, I think, get some pretty big sort of divergences. I mean, one thing that strikes me looking into this from a European perspective is that in the UK we now have an active debate, or have had in the MPC over the last few months, about whether you can even start to hike rates before you taper or before you end your QE program. So clearly there is a very broad range of opinion among central bankers on how you're supposed to sequence this stuff. But the importance for markets is that you can send some pretty big signals. And one of the possible outcomes from the Fed's taper, particularly if it is perceived by markets to send a signal about the start of a rate hiking cycle, is that we can start to see rate differentials open up between the US and non-US markets, and that carries a very grave implication for currencies against the US dollar. And so I think that when, from an investor's perspective, when we're thinking about the implications of Fed policy over the next year or so, that signal for the dollar is one of the most important. A strong dollar driven by widening rate differentials, driven in turn by the US economy being in a place that enables a much faster normalization of interest rate policy than elsewhere. For example, the Eurozone, where I think this was, as I think we've discussed, the starting point is that much more fragile, leaves a pretty optimistic outlook for the dollar. When I think about things from an emerging market point of view, that strong dollar is hugely important. If the dollar is going to strengthen against EMs, then you ain't going to end up in this situation that we possibly already find ourselves in, where EM central banks are having to tighten policy, even though their economies are not quite in a place that deserves it. So the 2013 experience, which Ed mentioned, is extremely pertinent for emerging markets. It was a fairly traumatic experience back then, partly because external balances in emerging markets were in a much more parlous state than they are now. The contraction in domestic activity over the course of the pandemic has sort of put paid to that a little bit. So we're probably in a slightly better position EM economy is not running quite so hot as they were, so the degree of tightening that they require is probably somewhat smaller. And we haven't seen quite the same sort of build-up of foreign participation in emerging market fixed income markets as we had before 2013. So I think we're probably a little bit more relaxed than we were relative to that experience. But clearly, this edging towards normalization via taper, via start of a rate hiking cycle, does carry some pretty big implications for non-US fixed income.
I'm so pleased you mentioned a taper tantrum, because the word taper in my head is always accompanied now by the word tantrum, and probably will be forevermore. But Adrian, sticking with you, and you mentioned the outlook there. Does this taper, or will this taper, have any impact on the relative appeal of US versus non-US fixed income as we move forward into next year?
Yeah, I mean, I think that's definitely the sort of from the EM perspective, it's a concern, because I think there is, as with all risk assets, there is a possibility that the taper takes or rather re-injects some risk premium into markets that QE has taken out. So we always need to be kind of on our guard from that perspective. As far as non-US developed markets fixed income is concerned, I think we would take a little bit more comfort, because like I said, the starting point for the Eurozone or for the UK suggests that those markets can withstand much less policy normalization than the US can, and if anything, the risk of policy error by central banks in the Eurozone and the UK is that much greater. We're already going to see, from this current inflation wave, we're going to see some downward pressure on real incomes. Those real incomes themselves were not boosted anywhere near as much as they were in the US by fiscal policy during the pandemic, because fiscal policy was modelled in a very different way. It was aimed in Europe towards supporting labour markets, which was extremely valuable, but it wasn't aimed at putting money into consumers' pockets in the same way as it was in the US. So we come from a much weaker starting point, and I think we'd be much more confident in leaning against expectations of rate normalization in this part of the world than we would in the US.
Okay, Adrian, Ed, and Chris, thank you very much for helping on this episode of Credit Threads. Another great conversation, I think, on inflation and all those catalysts for bond markets in the coming months. We'll be back next month with another look at macroeconomic central banks and more on inflation and their impacts on credit markets. And we'll see you next time. Thanks again.
Important information. This is an advertisement. This podcast is intended for informational purposes only and should not be considered representative of any particular investment. This should not be considered an offer or solicitation to buy or sell any securities or other financial instruments, or to provide investment advice or services. Investing involves risk, including the risk of loss of principal. Your capital is at risk. Market risk may affect a single issuer, sector of the economy, industry, or the market as a whole. The views expressed are as of the date given, may change as market or other conditions change, and may differ from views expressed by other Columbia Threadneedle Investments associates or affiliates. This information is not intended to provide investment advice and does not take into consideration individual investor circumstances. Investment decisions should always be made based on an investor's specific financial needs, objectives, goals, time horizon, and risk tolerance. Asset classes described may not be suitable for all investors. Past performance does not guarantee future results, and no forecast should be considered a guarantee either. Information and opinions provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. This podcast has not been reviewed by any regulatory authority. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In Australia, issued by Threadneedle Investments Singapore Pte. Limited, TIS, ARBN number 600 027 414. TIS is exempt from the requirement to hold an Australian financial services licence under the Corporations Act and relies on Class Order 03/1102 in marketing and providing financial services to Australian wholesale clients as defined in Section 761G of the Corporations Act 2001. TIS is regulated in Singapore. Registration number 2011015559W by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289, which differ from Australian laws. In Singapore, issued by Threadneedle Investments Singapore Pte. Limited, 3 Killiney Road, 07-07, Winsland House, 1, Singapore 239519, which is regulated in Singapore by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289. Registration number 2011015559W. This advertisement has not been reviewed by the Monetary Authority of Singapore. In Hong Kong, issued by Threadneedle Portfolio Services Hong Kong Limited, Unit 3004, 2 Exchange Square, 8 Connaught Place, Hong Kong, which is licensed by the Securities and Futures Commission, the SFC, to conduct Type 1 regulated activities, CE AQA 779. Registered in Hong Kong under the Companies Ordinance, Chapter 622, number 1173058. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In the UK, issued by Threadneedle Asset Management Limited, registered in England and Wales, registered number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG, United Kingdom. Authorised and regulated in the UK by the Financial Conduct Authority. In the EEA, issued by Threadneedle Management Luxembourg, SA, registered with the Registre de Commerce et de Société Luxembourg, registered number B110242, 44 Rue de la Vallée, L-2661, Luxembourg, Grand Duchy of Luxembourg. For investors in the Middle East, this podcast is distributed by Columbia Threadneedle Investments, ME Limited, which is regulated by the Dubai Financial Services Authority, the DFSA. The information in this podcast is not intended as financial advice and is only intended for persons with appropriate investment knowledge who meet the regulatory criteria to be classified as a professional client or market counterparty, and no other person should act upon it. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of Companies. ColumbiaThreadneedle.com.